the Pre-Money Show Minis, short videos with big insights for startup founders and investors. Today I'm going to talk to you about revenue-based financing, RBF, a very helpful way to raise capital to fund growth, working capital, or marketing campaigns. The way Virat Kohli saved India against Australia in the World Cup, RBF can save you during this funding winter. RBF is a type of financing where you get a loan based on your projected revenue. You repay the loan with a percentage of your revenue every month until you pay back the principal amount plus a fixed return. This means that your payments adjust according to your revenue growth. If you have a good month, you pay more. If you have a bad month, you pay less. You can expect to pay around 10% of the revenue, while the range could be anywhere from 5% to 20% of monthly revenue. RBF is ideal for startups that have a steady and predictable revenue stream, especially in the software as a service and D2C sectors. We have also seen B2B marketplace platforms getting RBF to purchase inventory and to fund working capital. You can also use RBF to bridge the gap between angel and venture capital funding. The best part about RBF is that you don't have to give up any ownership or control of your company. You also don't have to pledge any assets as security. This means you can focus on growing your business without worrying about losing your stake or defaulting on your loan. Tech startups generally do not have any hard assets to provide as collateral, so not having to provide any security could be very helpful for technology companies. However, RBF is not for everyone. There are some things you need to know before you opt for RBF. First, you need to have a minimum monthly revenue of rupees 1 crore to qualify for RBF from most providers in India. Second, RBF provider may need 6 to 9 months of runway in cash. Third, you need to be aware of the cost and duration of RBF. The interest rates for RBF usually range from 16% to 19%, which is higher than the average business loan rate in India. The repayment period for RBF typically lasts from 1 year to 2.5 years, depending on your revenue growth. Should you use RBF? Consider your business goals and financial situation. RBF offers a flexible and accessible alternative to traditional financing methods, but it has its own risks and challenges. Weigh the pros and cons carefully. In the current funding winter though, RBF could give your startup some liquidity to scale up. You may ask me, what if my startup does not have rupees 1 crore in monthly revenue? Well then, we are left with two options: equity and invoice discounting. We will cover these types of funding in future videos. Meanwhile, founders of promising startups, guess what? We are absolutely thrilled to hear from you. Yes, you. If you're raising funds, then let's talk. The Pre-Money Show podcast is here to aid investors in discovering and funding disruptive startups. So come on, join our journey on LinkedIn, The Pre-Money Show.